So a big week for tech, big tech. Nvidia reporting quarterly earnings on Wednesday. And then Intel climbing after last Friday's deal, giving a 10% stake to the U.S. government. For more on the markets and investment ideas, Geoff Barratt joins us, general partner at Barratt Capital Holdings. Thanks for coming in.
Thank you.
The Trump-Intel stock agreement.
Yeah.
Is this a precedent-setting agreement? Is there more to come?
Yeah, look, I think there is more. There are more deals to come. I think a couple things. So first, semiconductor, energy, raw material infrastructure is all really important to the country. I think they're worried that if China ever invaded Taiwan, for example, with fabs, the chip infrastructure would be compromised and it would hurt U.S. technological progress. And so the CHIPS Act was designed to give money to help encourage semiconductor manufacturing in the U.S., particularly in places where maybe there was a shortage of jobs, Ohio, for example, Arizona. And so I think what the Trump administration is saying is, look, we don't necessarily want governance control in these companies, and we're going to influence them anyways, but we should have some upside if we're going to give free money. And the CHIPS Act gave an enormous amount to Intel, and so they're really just converting that money to get an equity ownership. And I actually am fairly supportive of that as long as they're, not on the boards of the company. I think just giving money away for free seems fraught with problems. But if you tell a company that they're going to receive equity dilution as a cost of getting that grant money, then I think that's a different story and make companies operate a little bit differently. Is
that a winning bet, though? This is a company that has been behind many of its competitors for a long time.
You're right. They've really struggled. And so I want to say Intel's $100 billion market cap, or $90 billion market cap, actually. $100 billion is sort of the value you just put on the design software business, forgetting about the fab. And so if you split those, the fab's going to get some sort of value. The fab has stumbled, but there is an opportunity here as you go through AI inference for another chip company to come in and displace Nvidia. Intel is far ahead in that race. They have had low yields, so it's not translating into profits. But there's potential that they could advance there. And maybe if you separate those two companies, design and fab, where fab is able to manufacture for other companies and design is able to get chips manufactured in other places, there's a competitive rivalry that maybe encourages the company to improve. And so that's how I see the wisdom. I think it's actually a good idea. But I do understand, the hesitation to having the government-owned companies. Look, I think China is a big state country, and it's competitive with the U.S., and it's forcing the U.S. to do things that maybe in the past they wouldn't have done.
Okay, so let's talk about Nvidia as well. I'm wondering if you see the Mag 7 and that dominance that has played out for the last while sort of retreating a little bit now, even though Nvidia is expected to report strong earnings.
Yeah. Look, I think those companies are fine with earnings. I think there's enough money being spent in budgets this year for Google and Facebook and Microsoft that's going to keep the AI spending and chip supplying going for the remaining portion of the year. So I'm not worried about that. I was worried about that at the beginning of the year because I thought that the Republicans would push back on spending in the big, beautiful bill, and that didn't happen. And so it leaves these companies fine. Now, what I think they could suffer a little bit is multiple degradation because growth starts to maybe not be as strong. And then second is the market's broadening out. And I think the Fed announcement or the Fed speech on Friday was a good catalyst for that. But we have seen Russell 2000 performance this year. And to me, that speaks to broadening out of smaller cap companies. Typically, we have a lot of leverage. And so I think that's what we're seeing in the market. But I think, the earnings of these companies for the remaining portion of the year are fine and into next year. And then, look, I could paint a pretty rosy picture next year with a lot of spending that's coming out of the one big, beautiful bill, and that could really ramp GDP earnings and stocks as a result.
Okay, let's talk about a couple of areas that you like forward-looking. One of them is American house building or housing in general for long-term. Why?
Yeah, so look, I think we've had housing formation off the charts in the U.S., and that is always a precursor for home building. And what has prevented home building is the fact that the mortgage rate in the U.S., the 30-year mortgage, is 3.5% or 6.5%, and sometimes 7%. And so that's preventing people from being able to afford homes, frankly. And I think if the Fed cuts rates, I could make a case the whole rate curve comes down, and that's going to spur home buying. And so smart people with long duration investments profiles or views are buying into that sector. And where am I seeing that? Well, Berkshire's bought, 2 home builders recently. They have a longer duration, I think, viewpoint than most investors will look quarter to quarter. And I think the other one that, I've followed Brad at Jacobs for a long time. He created Waste Management, United Rentals, GXO, XPO, all of which have been massive successes over time. And what he's very good at is identifying sectors that are going to develop and consolidating them and then riding that fundamental wave. And I think it's not going to happen this year and maybe not even next year, but you could make a case if you could look 3 years out, you could see a real push in home construction, and that's a big multiple to the economic activity. And so that's kind of where I see the economy going. And look, I wanted to make another point that I think is really important. Like the overnight rate in Hong Kong is 0 right now. And Switzerland is 38 basis points. And what happens with those two currencies is they're pegged to the US dollar. And so when the US dollar is depreciating and the US starts printing money, they have to print money. And it's made the cost of capital so low. So if you're in Hong Kong, you can invest at 0, get a 4.25% rate in the U.S. with no currency risk. And to me, that's an amazing arb, but it's also fueling speculative activity that we've seen, IPOs and things. And so if you can bring down the Fed funds rate and reduce that arbitrage, it's going to push people out into the long end of the curve and equities, and that is generally a positive thing.
Okay, I do want to get to your one of your second or your next pick, which is Skydance, Paramount Skydance. Tell me about them. Yeah,
so look, they've gone through, a lot of problems. Sherry Redstone ran this company. There was a lot of leverage in it. It wasn't managed well. CBS has dragged it down a little bit because it's old media. But they sold the business, and Larry Ellison's son has bought it, financed with Larry Ellison, and they control the company. And it's got a new capital structure and some real momentum behind it. And the stock's been left for dead. It trades for 6 times EBITDA. Disney, in contrast, trades for 13 times EBITDA. And, I think they're going to go through this stage of redevelopment, and they have really strong content, which I think is what people want. And so, for example, they've already done their first move just after closing a couple weeks ago. They got UFC exclusively on Paramount Plus, and so that's going to drive viewership. Their movie business, which I think we can all say is pretty good, earns no money, and so it gets no valuation in the current market cap of the company. And I think what we've seen is a revival in movies, right? We've seen the F1 movie do extraordinarily well in some other movies this summer, and we're just starting to see supply of movies which is financed usually with debt come on. And so that's going to drive more content creation. And I could make a case that movie business in the next couple of years is going to do extraordinarily well. So that's how I kind of see it. It's a little bit of a bet on Ellison executing, but I don't see the downside. If the worst case is they don't execute and they sell the business, which would be in demand from Amazon or Netflix, then that's not a bad outcome.
Got it. Okay, we've got to leave it there, Geoff. Thanks for coming in.
Thank you.
Geoff Barratt, General Partner, Barratt Capital Holdings.